What's going on, everybody, and welcome back to another episode of the Trade for Yourself podcast, where my mission here is very simple. I just want to help you learn how to trade and invest in the stock market for yourself. So make sure you please like this, please subscribe. Make sure you listen to this episode from start to finish. I promise you, you will not regret it. Please note anything discussed in this episode is not financial advice. So please do your own research before investing into any stock. In this episode, we're going to be talking about the state of the stock market. The stock market went into a nasty correction, being down more than 10.93% from July 27th, down to October 27th. But shortly after that, we had a relief rally, and the stock market had the greatest week of 2023 last week, the first week of November, being up 6.97% from October 27th up to November 7th at the time that I am recording this video. The stock market went through extreme fear. We were in extreme fear during that time. There was fear about recession. There was fear about rising interest rates, bond yields. There were fears about the conflict going on in Israel. There were so many things that were affecting the stock market during that time. But we got some relief, and I believe that there are going to be some opportunities for the market to continue to increase and get back to that year-to-date high that we had in July. In this episode, I'm going to break down what happened over the last 3 months and what I believe the market can look forward to going throughout the next couple of months. Let's get into it. Hey everybody, so let's start off with the charts here. Now this is a year-to-date chart of SPY, ticker symbol SPY, which tracks the performance of the S&P 500. Now SPY had a year-to-date high of $459.44 around July 27th, and then SPY proceeded to have a nasty downtrend. And we know that it had a defined downtrend because it had a series of lower highs and lower lows, lower low, lower high, lower low, lower high, lower low, and we came down to $409.21. Now I've got an info line drawn here, and this info line tells me the decrease. It tells me the decrease that happened. So the S&P 500 went down 10.93% over 92 days, so over a 3-month time span. September is not a good month. Okay, it is historically the worst month in the stock market, and October is not that good either. So from July on, the stock market has not been doing well at all, and the market went into extreme fear. Why did the market go into extreme fear? It went into extreme fear due to fears about interest rates being higher for longer, the conflict happening in Israel, sticky inflation, fears about a recession, aggressive rises in bond yields, etc. Now, as you can see, the stock market went into correction territory. A correction is when the stock market drops 10% or more. Now, corrections are actually pretty common. Corrections happen all the time because that's just what the market does. That's how the market moves. But what we can see, like I said before, is that the market went into extreme fear. How do we know that the market went into extreme fear? Because we can look at the fear and greed index. Now, what does the fear and greed index measures? It pretty much just measures how investors feel about the stock market. The closer we are to greed, that tells us that investors are buying, buying, buying. The closer that we are to fear means that investors are selling, selling, selling. And investors have been selling a lot. And the bottom of the correction occurred around October 27th. And we had an extreme fear value of 22. So pretty much that pretty much coincides with that extreme fear with what I've been talking about. Now, right now, currently, we're at 41. We are at 41 on the on the fear and greed index, and just 1 month ago we were at 27. Like I said, over in the extreme fear area. Now why are we over in the fear area? Why have we gotten some relief? Now, if you've noticed, or if you've been paying attention, the stock market had the best week. The stock market had the best week last week, starting off in the month of November, than it has had in the entire month of 2023. That is amazing. So we have gotten some big relief. So let's draw another info line, shall we? So from the bottom of the correction on October 27th, all the way to where the market topped out on Tuesday, November 7th, the stock market has been up 6.94%. So what's really been the major reason why we've been having some relief? Why did we have the best week of 2023 last week? I'm going to tell you about a few things. The first thing you want to think about is about good earnings from companies. The earnings that we got from our S&P 500 companies was actually pretty solid. The Fed was not raising interest rates in their last meeting, and Jerome Powell was having a dovish tone. And the 10-year yield was dropping. Now, like I told you before, aggressive rises in bond yields was actually happening, okay? And I'm going to pull up the 10-year note right now. So if we look at the 10-year note, the 10-year Treasury note, the 10-year Treasury note was above 5%. That's the highest level that the 10-year note has been since 2007. Now, when you see this big increase, the big increase in terms of this particular yield, this means that bonds are not attractive. This means that bonds are losing their power, and people are trying to get off, and they're trying to sell their bonds because they don't want them. But we had a sharp decrease in this 10-year yield. It went all the way from above 5% to now we're around 4.579%. Now, why did that happen? The first reason why that happened was because of Jerome Powell and what Jerome Powell and the Federal Reserve decided to do at the last meeting. Now, this is a new tool that I have utilized. Shout out to Market Entertainment. Shout out to them for giving me this particular tool. Now, this is the CME group. And this tracks the Fed Watch tool. This tracks the probability of what the Fed will do in terms of interest rates at the next meeting. Now, there's a 90% chance that the Fed will not raise interest rates in December. There's an 84.6% chance that they won't raise interest rates in January. There's a 67.8% chance that they won't raise them in March. And when we get to May, there's a greater chance that they will lower interest rates than they will keep them the same. So when we get to May, we can start pricing in the probability of interest rates cutting. What does that mean? Okay. What this means is that if you've been paying attention, the Fed has been raising interest rates substantially since 2022. Why? Because they've been trying to curb inflation. They've been trying to stop inflation, and they've been trying to get inflation to stop. Now, the Fed said that, hey, we are going to stop raising interest rates right now at this moment, and we are going to be data dependent. We are going to wait, and we're going to see what the data shows. And what they want to see is that they want to see evidence that inflation is slowing down. Now, there was one thing that Jerome Powell said during his press conference that really stuck out to me. Like I told you before, the market went into extreme fear because of rising interest rates in terms of that 10-year yield. Jerome Powell said that the reason why the 10-year yield was rising was not because of expectations of interest rates from the Fed. He was pretty much saying that, look, We know that the 10-year note is rising, but it's not because of what we are expected to do from an interest rate standpoint. The way I took it was that, look, the 10-year yield has been rising, but there's something structurally wrong that has been happening with bonds, and that has been causing bonds to act abnormally. Okay, when you heard Jerome Powell say that, that's how you saw the interest rate drop from 5% down to 4.5%. What else did we get from a relief, right? What else did we get from a relief? We had the jobs numbers. The U.S. payrolls increased by 150,000 in October, less than expected. The Fed wants the job market to slow down and come back into better balance, right? This was a sharp decline from the gain of 297,000 that we had in September. So this is a very, very good thing. The market did not appreciate that large increase in jobs numbers from September. The unemployment rate also rose to 3.9%. And on top of that, we have to look at the average hourly earnings, right? The average hourly earnings was not as good either, and that had came down. The average hourly earnings, a key measure for inflation, increased 0.2% for the month, less than the 0.3% forecast, right? So what we have to understand is that this was a good thing from the Fed standpoint because they want the labor market to come back into better balance. What that means is that if the labor market, according to the Fed, if the labor market comes back into better balance, that's going to cause everything to get to an equilibrium standpoint, and that's going to continue to cause inflation to come down. And that is what the Fed wants. Me personally, this is a tool, this CME group, this Fed Watch tool, this is something that you need to continue to watch, and you need to continue to add this to your arsenal. Based on how the market has been pricing things in, and based on the relief that we're having, and based on these probabilities, I believe that the Fed is done raising interest rates. Okay, I believe that the Fed is done raising interest rates. If the Fed is done raising interest rates, that means that I believe the market has already priced in the worst of the situation. We just had a correction. But then right after the correction, we had the best week that we had in 2023. I think that we can look at this situation and we can say, hey, let's continue to watch what the Fed is going to do. I think that the Fed is going to be dovish because a lot of the data that they are anticipating getting, I believe that is going to be positive, and they're going to give some relief to the stock market, relief to investors, etc., etc., etc. This bodes well for a year-end rally because now earnings are good and we're not really worried about the Fed. So that gives the market the opportunity to price certain securities, price certain stocks based on the earning that the companies have given. The biggest takeaway that I really want you to take from in terms of this episode and the stock market itself is that the stock market always goes through corrections. There is a likelihood that at any time in any given year, maybe multiple times during that year, the stock market will experience a correction of 5% or greater, right? A real correction is defined by a drop in 10% or more from the year-to-date high. But at the end of the day, there's always going to be risk in the stock market. That's the reason why we put our money to work. That's the reason why you got your money in your 401k. That's the reason why you got your money in a brokerage account. That's the reason why you may trade options, things of that nature, is because you have to take a level of risk in order to get paid. There's nothing new in this particular time. What I want you to understand, I want you to pay attention to the landscape. Continue to pay attention to what Jerome Powell says in terms of interest rates. Watch the Fed. Continue to pay attention to the rising bond yields, okay? pay attention to these companies. The earnings of the S&P 500 has actually gone pretty well. And so I think that that's going to bode well for us for the remainder of Q4 going into next year. But again, we have to be careful. But just because we have to be careful, it doesn't mean that we shouldn't be putting money to work. It doesn't mean you shouldn't be buying Apple. It doesn't mean you shouldn't be buying Tesla. It doesn't mean you shouldn't be finding opportunities to buy Nvidia, AMD, Microsoft, etc. Because these are the companies that you need to be positioned to, I believe, going into the next 5 years, 10 years, and really truly have a stronghold in your portfolio. As always, I appreciate you all for tapping into another episode of the Trade for Yourself podcast. Please like, please subscribe. Make sure you hit that notification bell so you can be in the know every single time I drop an episode. Y'all already know I had to come on here to give you a state of the stock market to put some of the events that have been going on over the last 3 months into some level of context because, hey, we're in the last quarter of 2023. As always, remember, don't pay for it. Trade for it. I'm going to tap in with y'all in the next episode.